Hello, everyone. Welcome and thank you for being on our webinar this evening. We're excited to have Brittany Melville from Next Generation Trust Company here. She's going to share a little bit about Next Generation Trust Company and how self-directed retirement accounts work for real estate. And then I'm going to jump on and we're going to get into our presentation, which is the three most important aspects of a successful real estate investment portfolio.
Great. Thanks, Josh, for having us on yet another webinar together. We're always happy to share some education on this topic for people, as a lot of people are not familiar with it, even those that have been investing for many years. So, as Josh mentioned, I'm Brittany Melville. I am the Director of Marketing and Sales for Next Generation, and I'm going to talk a little bit about the company just briefly, but what we'll focus on educating you on tonight is a powerful tool, which is the self-directed retirement account, and how these tools can be applied for real estate investments. Also, we're going to do a little bit of a focus within the real estate segment on rental property tonight, as I think that we were going to focus on some best practices for that in general tonight. So I'll talk to you about how you can use these plans as a way to make these types of investments and earn some tax benefits as well. So the company Next Generation is a custodian and administrator for self-directed retirement accounts. So if you have a retirement plan with another institution, it might be with the likes of a Schwab or Fidelity or Morgan Stanley, for example. So what Next Generation does is very similar to what those institutions do with respect to holding the retirement account for you, doing all of the necessary tax reporting, record keeping, documentation, and processing any purchases or sale of any assets that you own within that plan. But the biggest difference for us is that we are focused on holding alternative assets specifically, and we're not a bank or a brokerage house. So just a quick disclaimer, we do not, although we do provide these financial services, we do not endorse, recommend, or sell any specific products. So if you are looking to do something like this, it is always best to make sure that you do your due diligence on any investments that you choose, or you can consult with a fiduciary if you have a financial advisor, some other sort of tax advisor that you would like to speak with about doing these investments to get that level of guidance. You sure can. And the information that we provide is for educational purposes and with respect to the services that we provide within our scope. So just a quick background on the company. We were founded in 2004, and our founder and CEO, Jamie Raskulnik, is still with us. We are a women-owned business based in New Jersey, and basically Jamie founded the company out of a desire to put real estate investments that she was already making as a broker herself into her retirement accounts, and trying to figure out how to do that led her to realize that this was something that could be done, and she felt very passionate about that option and spreading the word to others, so she founded the company. And since then, we've grown to hold over $600 million in assets, and we have participated in many avenues to share this information with investors, not only even across the country, but even worldwide in other countries as well. So we're very passionate about making sure that this continues to be something that people educate themselves on and take advantage of. So what is a self-directed IRA? Before we get into sort of the the weeds on this, for anyone who's really kind of just getting started, how to define it is really a retirement account that, for tax reasons, it works similar to any other retirement accounts that you would have, depending on the type. But what a self-directed IRA allows you to do is open up your investment options so that you're not limited to what you traditionally would be, which would be publicly traded assets like stocks, bonds, mutual funds. So here you're able to open up your options to include private and non-publicly traded assets and hold those within your retirement plan. So the beauty of that is that most people think that those types of investments can only be done with their personal funds, and if you earn a return on those investments, then you have to pay taxes on them immediately or in that year that you recognize your gains. But when you're holding them in a retirement plan, of course, your investment earnings as they go back into your retirement account, they remain tax sheltered. So depending on the account type you have, they might be tax deferred earnings, or they could even be tax-free earnings, which can make a significant difference from a financial perspective. And another benefit being that diversifying your portfolio beyond publicly traded assets gives you a hedge against some of the market volatility, especially that which we've seen over recent years. And it enables you to have a little bit more control over the return on those types of investments by giving you the ability to make a little bit more decisions and have more say in how you're managing those investments and what transactions you're actually authorizing to take place. So why this has become increasingly important is a shift in the retirement landscape. We have seen an increase in workers of retirement age remaining in the workforce because they don't have enough money to retire. And whether it's because they lost the bulk of their savings during the crash in '08, or they're just seeing an increase in medical expenses, other types of retirement plans that have historically been available to guarantee income are not as easy to come by anymore. So we are seeing an increase in workers remaining in the labor force. And one of the things that this suggests is that as historically people have relied on just traditional retirement accounts to save enough to kind of close that retirement gap, we're seeing that that's not happening as much, and that we're being forced to look at other options and to take a little bit more control ourselves of how we're managing our money. So in terms of the types of plans that can be self-directed, the types of retirement accounts you can hold that will allow you to do these types of investments, including real estate, would be all those that you see here. So most people are familiar with the traditional and Roth IRAs. So the traditional holds pre-tax funds, which are taxable when you withdraw them. And then the Roth IRA holds after-tax funds, which are basically tax-free withdrawals when you take those out at a qualified age. And then if you're a business owner, you have options that would allow you to contribute a little bit more out of pocket into your plans. And that would be the SEP IRA, Simple IRA, and then other types of qualified plans like solo 401ks. And then the last two are not really retirement accounts, but they can function similar to them in that they have tax benefits, and they also will allow you to make these types of self-directed investments. And then with a Coverdell, you can see you can use those funds for a child's education, and you can withdraw them tax-free. And then the same for an HSA, which most people are familiar with, but don't realize that they can actually self-direct, and they can strategically invest those funds into different types of products. So in terms of getting funds into the self-directed IRA, if you were to set one up, there are some different options you have available here. So I just mentioned a moment ago contributions, which are basically the equivalent of you taking your personal funds and then depositing them into your retirement account. The IRS sets annual limits on how much you can put into your retirement account depending on the type of account you open. So it's important to understand those if you're looking at different account types. But of course, you also have the option, if you have existing IRAs elsewhere with, for example, the Fidelities or Schwabs of the world, you have the option to liquidate a portion or all of the assets held in those accounts and transfer that cash over to a self-directed IRA to then use that cash for real estate investments, for example. If you have an old employer plan, like an old 401k that's just kind of sitting around and you've left the company, it's not doing anything, you can roll that over into an IRA. And then lastly, if you if you have funds in a tax deferred account and you wanted to move them into a Roth for tax-free earnings, you could do that. It would create a taxable event to move them over, but of course from there they would be tax-free. So what can you invest in? Real estate being probably the most popular asset class when we talk about self-directed IRAs and retirement plans, but you can see here that there are a lot of other creative sort of categories you can get into. Really, if you think about just about anything that's not publicly traded, with the exception, as you can see in red, with the exception of life insurance and collectibles, the IRS does not permit those assets to be held in an IRA. So as long as you're, your asset in question or the investment you're thinking about doesn't fall into those categories, it should be fair game to hold in an IRA. One of the other things we're seeing that's becoming more and more popular is impact investing or social investing. So investing into startup companies or causes that people feel strongly about, and maybe having an equity investment into some of those organizations might be something that people would be more interested in than just putting their money in the market. So there are several different strategies that you can use, and I guess we could also call them investment structures when you talk about using your self-directed IRA and how you decide to make an investment. But tonight, for the purposes of real estate investing, I'm just going to talk about this one here, and that's using your self-directed IRA to hold property. So you can do that by being the sole owner, and when I say you, I mean if you're using a self-directed IRA, your IRA becomes the buyer of the property and the owner of the property. So in the case of renting it out, your IRA would still own that property that's being held for rental. So you can either have your self-directed IRA own it 100%, or if you don't have enough funds in your IRA to purchase that property by yourself, you have some different options here. So at the top you can see you can either buy it outright with cash, you can finance it by getting a non-recourse loan, which is a specific requirement that you have to comply with if you're using an IRA to leverage property. And we've done Josh and I have done other webinars together on just the topic of non-recourse loans alone, just because there's a bit to go into there, and we're not going to get into it tonight. But if you do have any interest, feel free to reach out to us or either of us, and you can access one of our past webinars as well to get more information on that. If you don't want to go the non-recourse route, you can also partner your self-directed IRA with another buyer or buyers, so you could basically form a partnership. It could be two investors, it could be multiple investors, and those partners, as you can see further down on the screen here, could be your own funds. So you could partner with your IRA to purchase a property. You could partner your self-directed IRA with other people's self-directed IRAs. So if you were to get a bunch of, friends together or people that that'd be interested and they wanted to open their IRAs for the purpose of doing this, you could all partner into a deal, or other individuals with their personal funds. And then back up top, just a quick note, if you do buy and hold your IRA, obviously the earnings would be the equivalent of that rental income that you typically earn if you were renting out a property. And in the case of using the self-directed IRA, all that rental income would go back into your IRA, and that would be tax protected. So you wouldn't have to pay income tax on any of that as long as it's held in your IRA. So I sort of just alluded to this, but just to reiterate the way that the funds flow. The funds, they originate in your self-directed IRA. You then instruct your self-directed IRA custodian and administrator, which would be a company like Next Generation, for example, to move those funds out to purchase the property and any transaction associated with the property, including the deposit as well. And then all funds associated with the investment would flow from and to the plan. So any expenses associated with the property, such as property taxes, homeowners insurance, that sort of thing, would be paid out of your IRA's cash balance. And then any rental income would go back into your IRA in the form of cash. So if you have a rental, you probably want to make sure that you have some cash reserves in the IRA to cover unforeseen expenses, also knowing that that rental income that you're hopefully generating on a monthly basis going back into your IRA is also going to build those cash reserves. And then you have the option as well, as you continue to build that up, of using that cash to make a second investment. What you can make as many investments as you'd like within the same IRA, so you can own multiple properties within the same plan if you'd like. So you have the option to do that, or you have the option to maybe move the funds elsewhere, or you could take withdrawal out of your IRA depending on how old you are and what the tax consequences would be. So you have the choice as to what you'd like to do when you're earning that cash. So something important I do want to mention as it relates to any self-directed IRA investment, and I'll give some examples as this relates to real estate in particular and rental properties, are prohibited transactions. So we mentioned earlier that the IRS doesn't allow you to hold life insurance or collectibles in the retirement account, but the IRS also has other rules. So they get a little bit more specific here, and they also say if you're using your self-directed IRA to invest in any of the assets that we allow, we also look at who you're investing with and who's benefiting from your IRA's investment, because they don't want the IRA to be used as sort of a vehicle to just benefit other people other than the IRA holder or even the IRA holder personally. The idea is really that the IRA's investments are for the benefit of the IRA because it is a qualified retirement plan. So they basically say you're not able to really buy property from or sell property to what they call disqualified people. And I won't go into too much detail here, but just at a high level, the disqualified people they define are basically you yourself, any spouse, and then any ascendants, descendants, or their spouses. So if you look at your family tree in like a lineal direction, any of those individuals that are ascendants or descendants or spouses of them would not be able to directly engage in a transaction with your self-directed IRA. So that applies to, as I said, buying or selling, lending or borrowing funds that involve the IRA, extending any credit in the form of a guarantee, and then even just what's more of a gray area is the last bullet here, self-dealing, which comes into play when the IRA owner or disqualified person personally benefits from the IRA's investments. And that could be, an example of that could be you using your self-directed IRA to invest into a private company, for example, but let's say you're also getting paid a consulting fee to help them out on the side. So your IRA is earning funds related to the investment, but you're also paying yourself personally related to the investment. That would be considered self-dealing, and those types of examples, we want to try to avoid those. But more specifically, as it relates to real estate, what we're talking about when we say prohibited transactions, and these are the most common, is that you're not able to use any personal funds to cover expenses related to this property if the IRA is the sole owner of the property. If you wanted to make a contribution to the IRA, the only contribution you can make is in the form of cash. So you can't add things to the IRA that are not in the form of cash. You also cannot contribute sweat equity. So if you needed to do any repairs on the property, even if it were just some sort of like fixing a plumbing problem, unfortunately that can't be performed by any disqualified person. It would have to be done by a non-disqualified third party, which would usually be like a property manager or a contractor. And most of the time investors that have rental properties are using them, because if you've got multiple properties, it's a lot to handle that on your own. But that definitely is a restriction to be aware of if your IRA owns the property, that you can't do that sweat equity yourself. You also cannot let any disqualified people, we mentioned earlier prohibited transactions, so those disqualified people can't buy from you, but they also can't rent the property or live in it or use it. So you have to really be renting this out to unrelated tenants to you. And then the last one is pretty common. We come across this. It's a common misconception that people often mistakenly will find a property, sign the contract in their personal name, put down a deposit, and then call us and say that they want to put it into their IRA. And unfortunately, at that point, it's kind of too late in the process. You really need to open an IRA and get it set up and ready for the investment, and then do everything in the name of the IRA from the beginning, including putting down that deposit. So these are just some common things we come across and things to be aware of, that if you're investing with personal funds, you typically aren't thinking this way. but it's important if you do want to have those tax advantages using the retirement account that you do, you do look at these things. And the consequences of a prohibited transaction are pretty severe. So if it were to be identified, the IRA would be distributed back to the owner. So basically it would be as if you took a full withdrawal of the total amount of your account, which would be subject to taxes, penalties, back taxes if it happened in prior years. So it can get pretty messy, and really it's not meant to scare you. It's just meant to say that the IRS doesn't kid around, and it is important to make sure that you're educated, but also don't feel like you have to know everything. If you're not sure of something before you do it, you should call your custodian and ask them, and that's what they're there for, is to provide you with the guidance and the education. So the process for setting up an account with a self-directed IRA, it takes several weeks, and we get that question a lot too, is how long does it take from the time I open an account to the time I can make an investment? And these time frames really vary, and we try to be really conservative to say you should probably give yourself 4 to 6 weeks to get everything set up, although it could take less time, but we hate to put people up against investment deadlines that they might miss because of unforeseen variables. So really, the opening the account is really straightforward. You just complete an application. You can digitally sign it. It takes 1 to 2 days for us to get the account established, but funding the account is really kind of the factor that we don't have as much control over, because since most of the time your funds will be coming from another institution and another account you have somewhere else, we're sort of at the mercy of their processes and their requirements and their processing times. So we can definitely guide you through the process of making sure that you fill out all the right paperwork and follow the guidelines, but then it becomes sort of the ball's in their court, and we have to wait for those funds to arrive. And then the last part, obviously making an investment, would involve you submitting some paperwork to our transactions and compliance team. And what their job is to review every document that you've provided to us to make sure that on all the paperwork, your IRA and the name of your IRA is listed as the buyer, the owner of the property. The name of your IRA would be on the deed of the property, anything of that sort, which would help us protect the tax advantage status of your account and make sure that the investment's truly being done in the name of the retirement plan. So we do that review for you, and that takes about 2 to 5 business days, just because there can be a lot of paperwork and a lot of correspondence involved with the purchase of a property. So we do that for you, and then we process the actual, we can process the deposit. If that needs to be done quickly, that's not an issue. That doesn't take as long, but the actual purchase of the property, then, we would help facilitate that transaction. And just as a quick sort of FYI, when I say that we would ask for paperwork, some of the things that we would need to take a look at would be a set of our internal documents, which we would have you complete to just confirm some of the details of the purchase. The buy direction letter is basically a direction of investment that you'd submit to us, which would confirm your account number. You would sign it to authorize the transaction. You would also be letting us know the location of the property that you're purchasing, if there's like a closing agent or anyone else that we need to be talking to, title agency, anything like that, we have their information so that we can help make this as smooth as possible. And then, of course, how you want to pay for the transaction in terms of the fees that apply for that, and then where you want us to send the funds out of your self-directed IRA, if it's to, attorney escrow or anything of that sort. If there's a bank account we need to be sending it to, you give us that information and we conduct that transaction for you. And then, of course, supporting documents would include the purchase contract for the property and any other documents related to the closing. Again, those should be in the name of the IRA. Copy of the deed that is to be recorded, and then when it's available, the recorded deed we would need, as well as proof of insurance. So a note as well, our office actually signs the purchase and all those documents on behalf of your IRA. So as the custodian for the IRA, we would sign it, and you would mark them read and approved as the actual account holder. So that was just sort of a high level on self-directed IRAs as a powerful tool for investing. And then from a real estate perspective, we talked a little bit about rental property and the process for getting things set up, important guidelines to be aware of, and those prohibited transactions you want to make sure you avoid. So for the purposes of tonight, I'll leave you there, but if you do have any questions or you want to learn more, we have a plethora of information that you can read through. You can call and speak to me or my team further about any specific investment ideas that you might have, and we're happy to talk to you one-on-one. So with that, I'll turn it over to Josh to talk a little bit more about the real estate portfolio and best practices in general.
Perfect. Well, thank you so much, Brittany, and that's great information. I know we have a lot of people who are new to self-directed retirement accounts and are switching over from Fidelity's or Charles Schwab type accounts to do something alternative so they can not have to worry as much about the ups and downs in the stock market and what other countries are doing and things that are out of all of our control. Our company is SD IRA Wealth. I'm Josh Gilmore, and we are headquartered here in about to be very cold Chicago, Illinois, with a few other offices throughout the country. We have over 30 years of experience in real estate investing. We've done over 400 million in residential real estate, both new construction and rehab properties across 14 states and over 40 cities. We focus on buy and hold real estate. As I mentioned, I'm Josh Gilmore. I'm one of the vice presidents here. I'm also a buy and hold real estate investor with a portfolio of 12 properties now throughout the country myself. So hands-on, I've seen, the critical mistakes and the critical successes with real estate investing. And for tonight's webinar, we're going to focus on the 3 most important aspects of a successful rental portfolio. Now, if you aren't already, I would absolutely suggest that you take out a pen and paper or a pencil and paper so you can take some notes, have a few takeaways written down for the end of this webinar to take with you, whether you invest with a company or whether you go out and do real estate on your own. So in this specific order, and I'll break it down for you as well, is number 1, the team you work with is the absolutely most important part of a real estate investment. Number 2 is the market you invest in, and number 3 is actually the property. So I'm gonna share with you why a lot of novice investors who come in are going the wrong route when it comes to looking at the property first, because number 1 is the team you're working with. At the very least, even if you're doing real estate completely on your own with your retirement account, you have to have a property manager. You can't provide a service to your retirement plan, and managing a property owned by your retirement account is technically providing a service, so that would put you in a prohibited transaction. So at the very least, the property management team, in our case, working with a company like us, it's more full service. And the reason why that's number 1 is because you could have the greatest investment property in the world in the best market for real estate investing. And if you have a bad team, if you don't have a good management team taking care of that property for you, it's not going to perform well. You're going to have a bad experience, and they're not going to get the best tenants in there, and they're not going to take the best care of your property. You want property manager with an owner's mindset, especially since you can't do it yourself. And if you're looking to be more passive, you're going to want an experienced acquisition team, a research team, a lending team, etc. as you build this out and you build out a rental portfolio inside of your retirement account or outside. So the questions you want to be asking and looking at as you're verifying and doing your homework on property management companies and full service companies is their client reviews. What do their clients have to say? Where can you hear from them? Where can you get a recommendation? Their track record. Where have they been? Where are they going? How has their performance been? How long have they been around? You want to make sure a company's been around for a long time. What partnerships do they have? Who are they working with? And what does that say about the company? And ultimately the volume they do, how large they are, how many properties a property manager manages, or how much real estate has an investment company done that you're looking at working with. So where we come in is our company provides more of a full service solution, a soup to nuts solution for real estate investing inside of a self-directed retirement account or outside when an individual is looking to be more passive and have a partner that handles all the headaches and does most of the heavy lifting, just providing a solution. So we have a team of over 200 people with over 30 years of experience in real estate investing, from property management to real estate development to architects to on-site management teams to researchers and an acquisition team in-house. So we put together our team to do all the front-end evaluation to find the right markets to invest in. We actually acquire and develop and build rental properties in specific areas. We have a financing option where we actually bring in a third-party lender to do a final due diligence check. And in my opinion, that's the most exciting part of what we can offer our clients is non-recourse financing. And what we're focusing on as the number one most important is the team managing your property, the management end of things. So when we're doing a project, we have a full service professional management team doing a soup to nuts management of any properties we do. What does that include? That includes vetting tenants, holding security deposits. That includes turning units over when a tenant moves out and having advertising arms and marketing to make sure they're filling that vacancy as soon as possible to keep the cash flow coming. They're doing all the monthly statements for us, and ultimately their job is to keep this investment passive for us and for the clients we have who are buying the investment properties we do as well. So if you aren't familiar, there's a lot of different ways managers charge fees. We only focus on a full commission fee. What does that mean? So that means they get a percentage of the money they make us. So when your property is rented out at $1,000 a month, it's typically 8%, fixed 8%, $80 a month. When your property is vacant, which will happen, it's not a question of if, it's a question of when. The manager isn't making money until they find the next tenant, and they're incentivized not only to minimize a vacancy when a tenant moves out, but maximize the turnaround time and make that as quick as possible, and maximize the income, because the higher you raise that rental income, the more income the manager and you make. So it's a way to have them working full commission, where when there is a vacancy, they want to minimize it. They want to turn the unit over as quickly as possible. We'll talk about, why we focus on new construction properties, because they're lower cost to that turnover. And then ultimately, we want them vetting tenants to find great long-term tenants. That's their most important responsibility, because if you have a great long-term tenant who's there for 5, 6, 7 years, that's 5, 6, 7 years of passive, easy income. We want long-term tenants who have good credit. We verify that they have great income, they have a consistent job, 3 references from 3 previous landlords they have, background checks as well. And then the manager will do your monthly statements. Those are a few of mine right there. With the goal keeping this very, very passive so it fits the requirements you need inside of a self-directed retirement account. Now, in addition to the statements, we do things a little bit differently to maximize performance from our on-site managers. When we go out and do a project, we'll have 50 to 100 homes that we develop new construction. We have the management company set up on site. They report to us and our in-house team. We've vetted them, we've tested them out for 6 to 12 months. That's when we would bring in clients who could look at a portfolio of rental properties their self-directed account would buy from us. So Jim here finds 2 properties in our portfolio that are a fit to help him reach his goals. He acquires those properties. Nothing changes from a management perspective. The management team is still managing the properties, and as far as the tenants who are paying rent to the management company, they don't even know the properties have been sold. And now as Jim adds on more properties to help get himself to his ultimate end goal of being able to have enough passive income to retire, he has access to our in-house team. Now, this is the second level of service that really sets us apart from just having a property manager. With this, you have an in-house team that's in the office till 9 o'clock at night. That is a second set of eyes on any investment property you do with us. So this is where this 2-tiered approach gives us the best customer service and asset performance for our clients, because we have the power of having a management company managing a portfolio and jumping through hoops and doing discounted rates because they're getting such a volume of properties. Even though we as investors, my 2 properties in the portfolio of 100 are still my 2 properties, just like they're my clients' 2 properties when they own 2 separate ones. But it gives us the benefit of a larger client treatment. And that's where our in-house team really helps us with the customer service aspect and provides a great experience for our clients in helping them get to their goals. So number two most important aspect of a successful real estate investment portfolio is the market you invest in, both this type of state based on state laws and the microeconomics of the jobs and the specific types of cities we're investing in. So a lot of people will want to call up a realtor and look at a home close by and think, oh boy, I'd love to have it close by just to be close. And that's a mistake we see far too often, because you can similarly have the best investment property and have a great team managing it. But if you're in a bad investment market, tenants can take advantage of you and your taxes can go crazy and the expenses can get out of hand. So what do I mean by bad market or bad area? Well, I'll give you a couple examples here. So state law factors. Let's look at the major view of everything. And we're looking at two states here, a very pro-business, pro-landlord state on the left in Texas, and a very pro-tenant state on the right in Massachusetts. So in Texas, we love investing in Texas not only because it's got no state income tax and very pro-business laws. It's very easy for us to manage properties. The laws favor us as landlords, so our management companies on site have an easy time getting rid of a bad tenant, switching them out within 2 weeks. They have an easy time managing the properties. There's no having to go to court for anything. It's what's called a non-judicial state, and it's also a non-disclosure state, so you don't have to disclose your sale prices, and taxes are a lot more consistent than the Massachusetts, which is frankly the opposite. Tenants have more rights than landlords. It's very hard to manage properties. I've heard horror stories in markets like that. We all have at one point or another. So it's very important to focus on the right markets to invest in, where you as a real estate investor have a better benefit and there are better laws protecting you and protecting us as real estate investors. So that's where, our in-house acquisitions team is doing 8 to 12 months of research before investing in a specific area. We're looking at things like that major difference between states, but we're also looking at the types of cities and employment. Beyond having the right market in terms of the market's growing because it's business friendly and it's landlord friendly, so it's easy for us to manage properties, we want to be in areas that are stable and have a lot of potential for growth and minimize the downside risk. If you're investing in a place like California or along most of the coast, it's very boom bust. These are the types of markets we stay away from, because what we're buying real estate for is the passive income and the steady, predictable growth. So we love college towns, not for the college kids, but for the jobs it creates, the professors, the faculty and staff of the college. We love cities with a large healthcare index and a large urban market where there's always consistent employment. Healthcare is one of those industries that's truly recession proof. Regardless of what the economy does, what China does, what trade deal is, people are going to get sick in America and they're going to be taken care of. And people are living longer than ever before. And the fastest growing sector for Hallmark is actually Centurion cards right now, because that's amazing and it's great. And it's great for us if we're in the right area where we're able to capitalize on the consistency in healthcare and providing homes for people like that. So in addition to finding the right employments, we have 30 key indicators we use, and I won't bore you with all the details, but the big ones being the right types of state, the right major employers, under 5% vacancy across the board. That's a big one we look at. And we also look at building permits. Building permits is a really important data point because it tells you what developers and companies that are building hotels and hospitals and new shopping centers, they're doing millions of dollars of research and development to find the right area. So when we're able to see building permits increasing, it's a great sign that the market's going in the right direction with the right level of growth there. And the old saying, you get what you pay for, truly always rings true. So we spend a little over $3,000 a month on the analytics software we use over on the left, from your CoreLogic to your Valuation Vision and so on, to pool data on any given market we're looking at. Because one of the benefits to investing with the right team is you can invest anywhere in the country where it's the best. So we're not limiting ourselves or our investors to any specific market. We don't just invest in the backyard like I spoke of. We actually do most of our investing outside of Chicago because they're better places where we can get a better ROI, return on our invested dollar. And in addition to that, it's about timing. There's markets we've been in the past, in 2011, 2012, 2013, that were great back then, that our investors have made a lot of money in, like South Florida or Orlando or North Carolina. But today it's very expensive to buy there. So it's all about timing the cycle right, being like a Warren Buffett, where you get into the right market at the right time. So you move in ahead of the masses prior to the market correcting itself, and you have a lot of potential for appreciation and a lower downside risk for losing capital when it comes to the real estate investing you're doing. So hopefully now you can see, obviously the property is important, and we're gonna talk about the types of properties and why, but ultimately there are two more pieces that are more important. So whether you're going out and doing real estate investing on your own or working through a company like us, I would implore you to focus in on 1 and 2 before just jumping to 3. Because one of the things I've seen novice investors make a big mistake of is they're going to look directly at a property and just compare 5 or 6 properties and go with the highest ROI, the highest projected, keyword, projected ROI on an investment property, whereas not realizing anyone can put any number on a piece of paper. The question is, what backs it up? What reviews back it up? What track record backs it up? What research and homework backs it up? None of us have a crystal ball to predict the future, but through research and having the right teams on the ground and finding the right markets based on solid data, we're able to be very confident in our projections and accurate in our projections, where just because someone's put a high number on a piece of paper with a specific property doesn't mean you're going to hit that number. Having the right team and being in the right area are more important than what the actual property shows. But nonetheless, the property is number 3 for a reason, because it's still very important. And when it comes to doing properties, like I mentioned, we like to focus on new construction as well as sound rehab, so the maintenance stays low and it's an attractive asset for tenants to rent. With new construction, you have virtually no maintenance, so it's a very safe way to get into real estate. You're always going to have some maintenance with the house, but with a brand new property, it stands out in the market. And there's different types of properties. Our focus is on residential real estate because not only are the brick and mortar commercial sales model going out the window with the Amazons and the Walmarts of the world, but more importantly, no matter what the economy does, everyone needs a roof over their head. And in a down economy, there's actually more need for rental properties because there's less home buyers. So very important to focus on what type of property. The class of property is important. We're going to discuss that. Location, location, location. Location is key in your proximity to major employers, as well as shopping in certain important areas inside of a city, like schools and the crime rate. And then you also a financing option. That's my favorite part, and we'll get into that at the end. So we do all different types of residential real estate. I see on the left a duplex, on the right a single family home, and on the bottom right a multi-family building. And each specific type of property is different for each investor. For example, someone who's retired right now and needs immediate income and is going to keep the asset for 20 plus years would likely go with the building. Someone who's building up to retirement and looking for the highest return may go for the house to get some appreciation and some cash flow. And the duplex is a good little in between those two options, where you get 2 renters under one roof and quite a bit of curb appeal. So to each his own. That's more of something we're going to focus in on a one-on-one basis as we're looking at what's going to help you accomplish your goal and your why. Now, property classes is extremely important as well. And this goes back to working with the right team where you're getting an accurate property class that you're comfortable with, right? The sweet spot for us is B and C. We actually stay away from A class and D class and below. A class, believe it or not, you think, oh, the best school district, the best, lowest crime, safest neighborhood, I want my rental property to be there. That's thinking like a homeowner who's living there versus a real estate investor. And I'll explain. The best A-class areas are where homeowners are. Very few renters are there, so they always have a higher vacancy because there's less people in those neighborhoods looking to rent. The homes are more expensive. The taxes are higher, the insurance is higher, the price is higher. So not only is, even if it's rented, the ROI quite a bit lower, it's vacant so often, it's very rare you make a good profit on those investments. And the types of tenants you get, they are great tenants with great jobs, but they're typically only there for a year. They're moving in because they just got a job there and they want to shop around to find their own house, or they have their dream house being built. They're not the types of people who stay long term. Now, the opposite end of the spectrum that we also stay away from is your D-class properties. The D-class and below are the types of bad tenants who have a lot of evictions. They don't take care of the property. These are the lower end of the society. The sweet spot is both B and C class. Some clients are a better fit for B, some clients are a better fit for C. I have a little bit of both, but nonetheless, they share a lot in common, and they are where you've got individuals with steady employment, from cafeteria workers to janitors to LVNs to respiratory therapists to professors, all the way up through the C and B class. They have pride of ownership. They're good people who take care of their properties they're renting. They have lower cost for turnover because of that. You don't have anywhere near as often evictions, and these are more long-term tenants. We don't want a tenant in our property for a year and then to have to go through a turnover. We want tenants for 5, 6, 7+ years in our properties for long-term cash flow. So we focus on the B and C class for those reasons. In addition to that, you really want to pay attention to the location. That's why we always are close to the major employers. When we're in a town that has a large healthcare index, we want to be within a few miles of the medical district, so it's easy for our nurses and faculty and staff to get there. Same thing with the college. We want to be close, not close enough where we're student housing because we don't rent to students, but close enough where it's an easy commute for our tenants, and they're in a decent school district in that B to C range, and it's a safe area. So all that is very important, and if everything we do checks out, we're able to get a financing option. And Brittany touched on it quickly. We've got a financing option with what's called non-recourse financing, which in my opinion is the most exciting thing we can do for our clients. It's where we're able to get a non-recourse loan, which is an asset-based loan, so you can leverage your retirement dollar or your regular dollar without having to go to a bank and qualify for a mortgage. Now, non-recourse financing is essentially the opposite of your conventional loan, right? The mortgage on your house, where you went to your Bank of America or Wells Fargo, gave them your income, your W-2s. You have to give them everything short of a blood sample for them to qualify you for a loan to buy the property for a down payment. You still pay interest on that loan, but you're personally liable. You're collateral. Your other assets, your credit, it's all on the line for that mortgage. Now, when your retirement account buys an investment property, technically your retirement account is the owner of that investment property. So conventional financing like you have on your primary residence is not allowed. The only type of financing is this non-recourse financing, which is strictly 100% tied to the asset. So the lenders are going in and they're doing their due diligence like they do on you, but on the property, on the area it's in, on the neighborhood, the location, the market it's in, and the management team taking care of it. So they need to be 110% comfortable with the deal and the qualifications of the deal. So needless to say, getting this financing is very difficult. 9 out of 10 projects we look at actually get denied for this type of financing, so we don't move forward on them. So this is the final due diligence check, is having a third-party lender. By third party, I mean this lender is third party to me and you and any of our other investors who invest with us. That's the final due diligence check. So in addition to it being a great due diligence check that we're getting a great asset, it also lets us invest strategically to generate a higher cash return, appreciate at a higher rate, and hedge our risk as investors. So leverage is really key to making this from a good investment to an incredible investment. And I'll explain each one as well. We'll start with the appreciation end. When you utilize leverage, this is an example of a $150,000 home. Now, if you utilize leverage, we have the lender who's come in and they're putting in $100,000 per home as a non-recourse loan. So you as an investor only need to put in $50,000 as a down payment, and the lender will finance the other portion, and your retirement account will actually own the property. So on the left, you're taking $150,000 and you're spreading it out. You're putting 3 $50,000 down payments on each home. And on the right, you're just buying one property cash with your $150,000. So let's say the market grows by 2%, right? You have your $150,000 house, it increases by 3% in value. That's a $3,000 increase in value for the home on the right. Now on the left, you have 3 of those homes for the same amount invested, so you get triple the appreciation you otherwise would, and you gain $9,000 in home value. Think about any house 30, 40 years ago. Now imagine if you had 3 of those houses, how much wealthier you would be. That's the huge benefit to leverage inside of a retirement account, is it puts you in such a stronger position for appreciation. In addition, it lets you hedge your risk and put yourself in a safer position because you're not putting all your eggs in one basket. So you have $150,000 worth of stock and it drops, you lost, say 20%. So you lost $30,000. You're down to $120,000. That's all in one thing. Same with one house. You put $150,000 in one house, that's all you have. With leverage, you're able to spread that risk out. You're able to use less money to buy more house. So you can do what a lot of our clients do and buy houses in multiple different markets. So they're not only diversifying into alternatives, but they're diversifying into different real estate markets with different economics and protecting themselves from being overexposed to one specific real estate market. And the best number one reason why we use leverage is to generate a higher income return, because at the end of the day, we're doing buy and hold rental real estate for the income it makes us, right? So if you look at your left, that's an all cash purchase. And if you look at your right, same scenario where it is 3 properties with $50,000 down payment and a $100,000 non-recourse loan. So on the left, your $150,000 invested is generating $1,300 in rental income, no mortgage payment, property taxes $200 a month, insurance $40 a month, management $100 a month, maintenance $40 a month. So you're netting $920 a month, or $1,140 a year in net income. That comes out to a 7.4% ROI. It's okay, but not great, not spectacular. Now, if you look at the right, you're looking at $150,000, same amount invested, using $300,000 in financing. So you're buying 3 of these homes and you own $450,000 worth of real estate. Your monthly rental income is tripled. You're making $3,900. Do have a mortgage payment that collectively is $1,650. All the other expenses are tripled since you own 3 properties, yet at the end of each month, you're making $1,110 or $13,320. So on the same amount invested, the same properties, just using leverage strategically, you make over $2,000 more a year in net income. So that $3,900 minus $1,650 minus $600 minus $120 minus $300 minus $120, you're still at $1,110 a month, or over $2,000 more per year. And in addition to not only making a higher cash flow return, your tenants are paying that mortgage payment for you. So just like when you make a mortgage payment and part of it goes towards principal and part of it goes towards equity, this works the same way with your investment properties. So in addition to the $13,320 you're making in cash flow, you're reducing the principal balance in year one by $46.50. So that's just from the tenants making those payments for you, and that puts you at a 12% return versus a 7.4% return on the same exact properties with the same amount of money invested. Now, if that's not good enough for you, think about what you can do over time as you're planning for retirement. So all this income is coming back to the retirement account, tax deferred or tax free, depending on if you have a Roth or traditional. So you're making $46.50 in principal reduction. In addition, you're making $13,320 in cash flow. Why not put that money into the mortgage and pay down the mortgage quicker? That's what a lot of our clients do to really maximize their retirement, and they reduce their mortgage to $282, then $264, then $246, then $227, and in about 12 years, you can actually have this property, these 3 properties, free and clear with no mortgage payment left on them, and generating you $36,000 a month, or excuse me, $36,000 a year or $3,000 a month. That's versus the initial house just at $1,000 a month. So big difference in terms of what you can do with this leverage. Won't get into too much details, but we talk about on an individual basis freedom level wealth portfolios and getting you to a number where you're content being retired with the income you have. Where we come in, as I mentioned, is more of a full service passive solution where we have an inventory of properties with tenants in place, property management in place, access to our team for the life of the investment, hand-selected markets based on our research, and having the pre-approved non-recourse loan on every property we do to be the ultimate due diligence check. So, like I mentioned, when you're looking at companies, you want to look at what their reviews are, what their clients have to say. We're proud we've got a lot of reviews on LinkedIn. We've got a testimonials page where people have been kind enough, happy clients of ours have been kind enough to leave videos. A couple thoughts to leave you with as you're looking over your notes. This is a great solution if you want passive experience and high ROI. You don't want to spend your time and energy doing rehabs. You don't want to have to worry about hiring contractors. You could care less about the color of the paint and the other materials. You don't want to have to be the one interviewing all members of your team and picking everything out. That's the type of investor we're going to add the most value to, is the investor who wants to be hands-off and passive. Now, if you're active in the real estate space, you prefer to be hands-on, maybe you're some type of financial advisor or wealth coach who works with clients, we do have a referral program. So we are able to help you add a revenue stream, offer more options, really broaden your exposure. And we do webinars like this on a weekly basis with our referral partners as well to educate their clients about the alternatives out in this space. And I know we're running a little bit late here, but I do want to jump over with Brittany and answer some questions. I see some coming in right now, and anyone who would like to, feel free to write a question in the question box or put in a question to the chat box, and we'll be happy to discuss anything you might have. Here's a good one, Brittany. How do I create a self-directed IRA with you?
So the first step, it would basically be that, sort of to simplify things, that 3-step process that I went over toward the end. To create a self-directed IRA, you would fill out an application to open an IRA. You can have as many IRAs as you want, so it's okay if you have an IRA somewhere else or you have multiple ones. You would just create an additional one to be held by Next Generation, for example, and then that would be your self-directed IRA. So that would give you the ability to make the real estate investment. So by completing the application, you provide your personal information, like a social security number. We do identity checks. So as a financial institution, we are regulated by the Banking Commission. So we go through that whole process to establish your account, and we give you a 4-digit account number. And then at that point, you would have a self-directed IRA that you would have the option to fund and start investing with.
Excellent, excellent. So let's see here. So as an investor, will we own a percentage of the property projects you do? No, actually, well, yes and no. So say we do 100 homes and you buy one of those homes, you would own 1% of the project, but you would also own that individual home deeded. So you're not sharing it with other investors. You get control on when you want to pay the loan down, when you want to sell, what you want to do with the property, as long as you stay within the IRS guidelines, assuming it's an IRA and you don't let a disqualified person live there, or you can't live there. But technically your retirement account would be the owner of the property, not a shareholder in our investments. When does the income typically start when I make a purchase? So once you actually complete the purchase and close, so depending if you have a funded account, that could be a 2-week process. If you have to open an account and fund it, that could be a 4 to 6 week process. But in doing so, we would get the property cash flowing starting from day one. So there's a lot that since our property is already rented out before the sale, once you've moved forward and picked out the portfolio, you are able to generate the income right away. How would we go about getting started? So great question. Our contact info is all up there as well. So whether you're looking to do the IRA first or discuss with us the real estate and then go to the IRA, I'm also going to send out to the chat, to the group right now, a link to our calendar where you're able to schedule a call directly with me at a time that works for you, and we can go over any questions you have one-on-one, talk about properties, talk about the lovely weather we're having here in Chicago, and see if there's something we can do to help you reach your goals, what it's all about. Here's a good one, Brittany. Is there a penalty if I move from an IRA to a self-directed IRA?
Great question. No, there's not. So let's say you have, for example, a traditional IRA with Fidelity, and you want to open a traditional IRA with Next Generation and move the funds from IRA to IRA. Anytime you're moving funds, basically it's called a trustee to trustee transfer. And it's a non-reportable and a non-taxable event, so it doesn't even show up anywhere on any tax reporting because the funds basically are leaving an IRA and going directly into another one, so you're never taking a receipt of the funds. It's not actually considered like distribution. So you actually can do as many of those transfers as you like between as many IRAs as you want, and you're not limited at all. So that's usually what we see as the most common way people fund their accounts, moving them from other IRAs.
Excellent, excellent. How many offices do you have and where are they located? So we have offices in Minneapolis, Tampa, here in Chicago, and Boston as well. So in addition to that, one of the things to mention too, one of our financial advisors who works nationwide just like we do, it's not necessarily about working with places that are people that are close to you. Just like investing in real estate, you want to invest in the best markets. You want to work with the best people regardless of where they are. We work with people all over the world that invest with us because of our track record and history and the results they get. It's not so much about them investing close by. So it's definitely a mindset thing in terms of getting the notes right and what we discuss. But that's the mindset of being successful is going outside the box and doing what's going to get you the best ROI and the best return on investment for your capital you're using. How would I share this with my investor group? Great question. A lot of times webinars like this, we're going to have a recording of a webinar, this specific webinar. If it's a big enough group, even a small group of 10 I've done before for investors and smaller REI groups, and it's fun to do that type of thing. We have a team that handles that would be excited to be able to share that and help you learn about alternatives like this and self-directed IRAs.
Same here. If you wanted something that was self-directed IRA specific, we will, as Josh said, we'll record the webinar, and we also do webinars for groups as well. And depending on where you're located, sometimes we even come out personally and do some educational sessions. So definitely reach out to us. There's a lot of information we can share electronically.
Excellent, excellent. And I know we're running a little late here, so I think we'll do one more and then wrap up for this evening. As I mentioned, our contact info is there if you'd like to save it and screenshot it, as well as the link to our calendar. Let's see here. So in terms of exiting a market, who decides that? Is it up to me as an investor or your team? So at the end of the day, when you own a property, you decide it. So you can leave earlier than most of the investors. You can leave after. You can leave at the same time. You can never leave. A lot of our investors keep these properties and let the income be what they live off of, and then the properties go inside the retirement account to their heirs, where the retirement account will pass on down the road. So there's a lot of different options, and one of the benefits of working with us is you're in full control 100% of the way. Excellent. Well, thanks so much, Brittany. Appreciate you being on. It's always fun to do a webinar and get to educate some new people this evening. And thanks everyone for being on.
Yep, pleasure being on again. Thanks, Josh. Appreciate it.
Absolutely. Have a good night and get home safe, everyone.
Take care, everyone. Good night.